I've watched people repeat the same mistakes for decades, and the root cause is always the same. They are hypnotized by the allure of the market, seduced by the stories of overnight millionaires, and blinded by the emotional roller coaster of greed and fear. They treat investing as a game of chance, a roll of the dice in a grand casino. They are wrong. The market is not a casino. It is a complex system, a vast ocean of data. And within that data, there are patterns, there are signals, there are truths. But these truths are not revealed to the emotional, the impulsive, or the intellectually lazy. They are revealed to those who are willing to do what most people ignore. To think with rigor, with discipline, and with a relentless focus on the underlying mathematics of reality. I've seen brilliant minds fail because they overlooked one simple truth. The universe is not governed by narrative. It is governed by mathematics. The same is true of the financial markets. The stories you hear on the news, the hot tips from your friends, the gut feelings that scream buy or sell, these are noise. They are the siren songs that lure unsuspecting sailors to their doom. The real signal, the true path to wealth, is found in the cold, hard language of numbers. It is found in the elegant dance of probabilities, the unwavering logic of algorithms, and the dispassionate analysis of data. This is not a popular view, it is not a sexy view, but it is the only view that has consistently and profitably navigated the turbulent waters of the market for decades. Today, I will not offer you a magic formula. I will not give you a stock tip. I will give you something far more valuable, a framework for thinking, a way to see the world not as a collection of stories, but as a system of equations waiting to be solved. I will reveal the 3 fatal mistakes that condemn the average investor to a lifetime of mediocrity. And I will replace them with 3 mathematical principles that have been the bedrock of our success at Renaissance. These are not opinions. These are the distilled lessons from decades of empirical research, of testing and retesting, of failing and learning. If you want wealth, if you want to escape the cycle of emotional investing, then you must first do this. You must learn to think like a mathematician. The human mind is a storytelling machine. We are wired to see patterns, to create meaning, and to weave narratives that make sense of the world. This is a powerful evolutionary adaptation. It has allowed us to build civilizations, to create art, and to pass knowledge from one generation to the next. But in the world of investing, this strength becomes a profound weakness. The stories we tell ourselves about the market are almost always wrong. They are oversimplifications of a complex reality colored by our biases, our hopes, and our fears. Consider the story of the visionary CEO, the charismatic leader who is single-handedly revolutionizing an industry. The media loves this story. Investors love this story. It is simple, it is compelling, and it is almost always a dangerous illusion. The success of a company is not the result of one person's genius. It is the result of a complex interplay of factors: market conditions, competitive landscape, technological innovation, operational efficiency, and 1,000 other variables. To bet on a single person, no matter how brilliant, is to ignore the vast majority of the data. It is to substitute a comforting story for a rigorous analysis. At Renaissance, we do not invest in stories, we invest in signals. We collect vast amounts of data, from the price of a stock to the weather in a particular city, and we use sophisticated mathematical models to identify subtle, non-random patterns. These patterns are our signals. They are not always intuitive. They do not always make for a good story. But they have one crucial advantage. They are statistically significant. They are based on evidence, not on emotion. We are not looking for the next Steve Jobs. We are looking for a persistent anomaly in the data, a small but predictable edge that we can exploit over and over again. This is a fundamentally different way of thinking. It requires a conscious effort to suppress the narrative instinct, to resist the temptation to create a story that explains the data. It requires a deep and abiding respect for the complexity of the world and a humility to accept that our intuitive understanding is often flawed. The first step to becoming a successful investor is to stop listening to the stories and to start listening to the numbers. It is to recognize that the market is not a drama to be interpreted, but a data set to be analyzed. Another cognitive trap that ensnares the average investor is the illusion of control. The belief that they can predict the future, that they can time the market, that they can outsmart the collective intelligence of millions of other participants. This is a particularly seductive illusion. It feeds our ego, our desire to be the master of our own destiny, but it is an illusion nonetheless. The financial markets are a complex adaptive system. They are characterized by feedback loops, emergent properties, and a level of unpredictability that defies even the most sophisticated forecasting models. Think of it like trying to predict the weather. You can look at the satellite images. You can analyze the atmospheric pressure. You can run complex simulations on a supercomput, and you might be able to make a reasonably accurate forecast for the next 24 hours. But if you try to predict the exact temperature and wind speed in a specific location a month from now, you are engaging in a fool's errand. There are simply too many variables, too many interacting forces to make a reliable prediction. The same is true of the market. You might be able to identify a short-term trend, a temporary inefficiency, but to believe that you can consistently predict the long-term direction of the market is the height of arrogance. At Renaissance, we do not try to predict the future. We try to identify and exploit statistical arbitrage opportunities. We look for small temporary mispricings between related securities. We build models that can identify these opportunities and execute trades with lightning speed. We are not betting on the future. We are betting on the law of large numbers. We are making thousands, even millions of small, uncorrelated bets, each with a slightly positive expected value. The outcome of any single bet is uncertain. But over a large number of bets, the law of averages ensures that we will come out ahead. This is a profoundly humbling approach. It requires an acceptance of our own limitations, a recognition that we cannot outsmart the market. It requires a shift in focus from prediction to process. Instead of trying to be a hero, a visionary who can see the future, we strive to be a disciplined, systematic operator who can execute a profitable strategy with ruthless efficiency. The second step to becoming a successful investor is to abandon the illusion of control and to embrace the power of process. Of all the mistakes that investors make, the most destructive, the most pervasive, and the most difficult to overcome is the tyranny of emotion. Greed, fear, hope, regret. These are the four horsemen of the investment apocalypse. They cloud our judgment. They distort our perception of risk, and they lead us to make irrational decisions that are contrary to our own best interests. We buy at the top of the market, fueled by the greed of missing out. We sell at the bottom, consumed by the fear of losing everything. We hold on to losing positions, hoping that they will turn around. We sell winning positions too early, afraid of giving back our gains. These emotional responses are deeply ingrained in our psychology. They are the legacy of a time when our survival depended on our ability to react quickly to immediate threats. But in the world of investing, these instincts are a liability. The market does not reward emotion. It rewards discipline. It rewards patience. It rewards the ability to stick to a plan even when it is uncomfortable, even when it is counterintuitive. At Renaissance, we have gone to extraordinary lengths to remove emotion from our investment process. Our trading is almost entirely automated. Our models are developed by teams of mathematicians, physicists, and computer scientists, not by traders who are susceptible to the emotional whims of the market. We have a saying, if you have an opinion, you're fired. This is not a joke. It is a reflection of our core philosophy. We do not want opinions. We want evidence. We do not want gut feelings. We want algorithms. We do not want human traders making emotional decisions. We want a systematic, data-driven process that can be executed without fear or favor. This is not to say that we are robots. We are human beings. We have emotions. But we have designed a system that prevents our emotions from interfering with our investment decisions. We have created a firewall between our psychology and our capital. This is the third and perhaps the most important step to becoming a successful investor. To recognize the destructive power of emotion and to build a system that protects you from yourself. Now that we have identified the three fatal mistakes that plague the average investor, let us replace them with three mathematical principles that have been the foundation of our success. These are not get-rich-quick schemes. They are timeless principles that, if applied with discipline and rigor, can transform your relationship with the market and put you on the path to long-term wealth creation. Asterisk, asterisk, principle one, the law of large numbers, asterisk, asterisk. The first principle is the law of large numbers. This is a fundamental concept in probability theory that states that as the number of trials of a random event increases, the actual results will converge on the expected value. In the context of investing, this means that if you have a strategy with a positive expected value and you execute it a large number of times, you are virtually guaranteed to make money. The key is to have a strategy with a positive expected value and to execute it with discipline and consistency. This is the opposite of the typical investor's approach. The typical investor makes a small number of large concentrated bets. They are trying to hit a home run. They are trying to get rich quick. But this is a low probability strategy. It is a recipe for disaster. A single bad bet can wipe you out. A more rational approach is to make a large number of small uncorrelated bets, each with a slightly positive expected value. This is the principle of diversification taken to its logical extreme. It is the principle that underpins our entire investment philosophy at Renaissance. Asterisk principle 2, the power of compounding. Asterisk. The second principle is the power of compounding. This is a concept that is often talked about, but rarely understood in its full implications. Albert Einstein is said to have called compounding the eighth wonder of the world. He was not wrong. The power of compounding is the power of exponential growth. It is the power of your money making money, and then that money making more money. It is a force of nature that over time can turn a small initial investment into a vast fortune. But compounding only works if you let it. It only works if you are patient. It only works if you resist the temptation to constantly tinker with your portfolio, to chase the latest hot trend, to try to time the market. The typical investor is their own worst enemy when it comes to compounding. They are constantly interrupting the process, constantly resetting the clock. They are like a gardener who is constantly digging up their plants to see if they are growing. The secret to compounding is to plant the seeds, to water them regularly, and then to leave them alone. It is to have a long-term perspective, to think in terms of decades, not days. Principle 3, the Kelly criterion. Asterisk. The third and final principle is the Kelly criterion. This is a mathematical formula that is used to determine the optimal size of a series of bets. It is a formula that balances the potential for growth with the risk of ruin. It is a formula that tells you how much of your capital to risk on any given bet in order to maximize your long-term growth rate. The Kelly criterion is a powerful tool for risk management. It is a way to ensure that you are taking enough risk to grow your capital, but not so much risk that you are in danger of blowing up. This is a far more sophisticated approach to risk management than the simplistic rules of thumb. They're often peddled by financial advisors. The Kelly criterion is not a one-size-fits-all solution. It is a dynamic formula that takes into account the specific characteristics of your investment strategy. It is a formula that requires a deep understanding of probability, of expected value, and of your own risk tolerance. But for those who are willing to do the work, it is a formula that can provide a significant edge in the market. I have given you a lot to think about. I have challenged some of your most deeply held beliefs about the market. I have told you that your intuition is not to be trusted, that your emotions are your enemy, and that the stories you tell yourself are a dangerous illusion. I have told you that the path to wealth is not through narrative, but through mathematics. This is not an easy path. It is a path that requires discipline, rigor, and a relentless focus on the data. But it is a path that is open to anyone who is willing to do the work. So I ask you to do this the next time you are tempted to make an investment decision based on a story, on a gut feeling, on a hot tip. I want you to stop. I want you to take a step back. I want you to ask yourself, what is the evidence? What is the data? What is the underlying mathematics? If you can do that, if you can learn to think like a mathematician, then you will have taken the first and most important step on the road to long-term wealth creation. You will have done what most people ignore, and you will have given yourself an edge that few can ever hope to achieve. Now, I want you to do one more thing. I want you to go to the comments section and write one sentence about how you will apply the lessons of this video to your own life. How will you begin to think like a mathematician? How will you protect yourself from the tyranny of emotion? How will you embrace the power of process? Your journey starts today. The choice is yours. Let us delve deeper into the nature of the narrative trap. It is not merely the media's oversimplification that is the problem. It is the fundamental human need for causality. We demand at times reasoned times for every market movement, inventing stories to explain every rise and fall. This provides a comforting sense of understanding, but this comfort is a lie. The truth is that most market movements are the result of a confluence of millions of uncorrelated, small, and often irrational decisions. They are the result of noise. Trying to assign a single clean narrative to a chaotic system is an exercise in self-deception. Our models do not care about the CEO's charisma or the geopolitical tensions. They care about the time's residuals, times the tiny persistent deviations from what the established models predict. We are not looking for the grand overarching theory of everything. We are looking for the small repeatable anomalies that occur because human beings are predictable in their irrationality. For example, consider the post-earnings announcement drift, a statistical anomaly that persists because the market is slow to fully incorporate new information. It is not a story. It is a mathematical inefficiency. To overcome the narrative, you must cultivate a profound intellectual detachment. You must train yourself to see the world as a stream of data points, not a sequence of events. When a major news story breaks, your first question should not be, what does this mean? But how does this change the statistical distribution of the variables in my model? If the answer is it doesn't, then the news is noise, and you must ignore it. The market is a language, and if you want to understand it, you must stop listening to the poetry and start reading the code. The illusion of control manifests in two particularly destructive ways: overforing and overtrading ***, over forecasting ***. The human ego demands certainty, leading us to pay for long-term economic and market forecasts whose accuracy is statistically indistinguishable from random chance. The complexity of the global economy makes precise long-term prediction impossible. We at Renaissance realize the signal-to-noise ratio in long-term forecasting is abysmal. The only place where the signal is strong enough to be reliably exploited is in the very short term. Our models operate on time horizons measured in days, hours, and even minutes. The shorter the time horizon, the less time there is for chaotic, unpredictable forces to corrupt the signal. We are not trying to predict the destination of the ship. We are predicting the next tiny momentary wave that will slightly push it off course. This systematic approach exploits fleeting microscopic inefficiencies. It is about having a superior process for recognizing and acting on the limits of predictability. ***, overtrading ***. The illusion of control also leads to the fatal mistake of overtrading. The emotional investor feels compelled to times do something ***, confusing activity with productivity. Every trade incurs a cost, a commission, a spread, and the risk of being wrong. The more you trade, the more you expose yourself to these costs. Our system trades frequently, but this is a function of the model, not an emotional impulse. Every trade is a cold, calculated execution of a statistically validated signal. There is no deliberation, no second-guessing, no human intervention. The lesson here is profound. ***. In the absence of a statistically validated signal, the optimal action is inaction. ***. The greatest discipline an investor can possess is the ability to sit still, to let the process work, and to resist the urge to tinker. Abandon the illusion that your personal moment-to-moment judgment can improve upon a rigorously tested, systematic plan. Your control is an illusion. Your process is your reality. The tyranny of emotion is not just about greed and fear. It is about the subtle, insidious ways our psychology distorts our perception of risk and reward. It is about cognitive biases, the predictable, irrational shortcuts our brains take to process information. ***, confirmation bias, ***. We seek out information that confirms our existing beliefs and ignore information that contradicts them. This creates a closed loop of self-reinforcement leading to overconfidence. Our models have no beliefs to confirm. They process all data equally without prejudice, constantly challenging their own assumptions. ***, loss aversion, ***. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. This bias leads investors to hold on to losing positions far too long, hoping to get back to even, violating the law of large numbers by making a large concentrated bet on a single failing outcome. Asterisk, asterisk, the endowment effect, asterisk, asterisk. We tend to overvalue things we own simply because we own them, making it difficult to sell a long-term holding even when the data suggests it is overvalued. The only defense against these psychological tyrannies is a asterisk, asterisk, system, asterisk, asterisk. A system is an externalized objective decision-making framework, a set of rules you commit to times before times your emotions are engaged. The system dictates the entry, the exit, and the position size. Your only job is to execute the system with perfect fidelity. The profound insight of the quantitative approach is that we eliminate the times, opportunity times for human emotion to interfere with the trading process. We build a machine that is immune to hope, fear, and ego. It only cares about the statistical edge. This is the ultimate form of discipline, not self-control, but asterisks, asterisk, system control, asterisk, asterisk. Compounding's true power lies in its nonlinear relationship with time. Most people think linearly, seeing wealth accumulation as a straight line, but compounding is an exponential curve. The early years are slow, almost imperceptible, and this is where most people fail. They interrupt the process before the exponential curve begins its ascent. The true magic happens in the later stages, when returns are generated on accumulated returns. The difference between a modest annual return and a slightly higher one compounded over decades is a difference of orders of magnitude. The small, consistent edge our models provide when compounded creates generational wealth. To harness this power, you must adopt the mindset of extreme patience and consistency. You must view every day of disciplined execution as a tiny, almost invisible contribution to the exponential curve. You must protect your capital fiercely because every dollar lost in the early stages is a dollar that will not compound for the next 20 or 30 years. Furthermore, compounding is not just about money. It is about asterisk, asterisk knowledge, asterisk, asterisk. Every time a model fails, we do not discard it. We analyze the failure. We learn from the data and we refine the algorithm. This is the compounding of intellectual capital. The system gets smarter, more robust, and more profitable. With every iteration, the lesson is clear. Asterisk, asterisk, consistency is the catalyst for exponential growth. Asterisk, asterisk, the principles I have laid out, abandoning the narrative, rejecting the illusion of control, and neutralizing the tyranny of emotion are not merely investment strategies. They are philosophical call of typical regular demand. This is a mirror reflecting selective the rationality of humanity, but it offers a unique opportunity for those who transcend their irrationality, really for those of irrationality. The edge is not in finding a secret formula. The edge is in the asterisk, asterisk process, asterisk, asterisk. It is in the discipline of showing up every day, collecting the data, refining the models, and executing the trades without hesitation or regret. The most common question I receive is, what is the secret to your success? The answer is far simpler and far more difficult for most to accept. Asterisk, asterisk. We built a system that works and we never deviated from it. Asterisk, asterisk. We did the hard work of quantifying the world, and then we had the discipline to let the numbers speak for themselves. You must stop looking for the easy answer. You must look inward and recognize the flaws in your own decision-making process. You must look outward and recognize the complexity of the world. And then you must commit to building your own system. A system based on logic, on data, and on the unwavering principles of mathematics. The path to wealth is not paved with gold. It is paved with code. It is paved with the relentless pursuit of a statistical edge. The humility to accept that you cannot predict the future, but you can manage the probabilities. The greatest risk in life is allowing your financial future to be governed by the human flaws of emotion and narrative. You have the capacity for logic and discipline. Use it. The choice is between a rational systematic process and an emotional chaotic one. Choose the former and the wealth will follow. Choose the latter and you will forever be a victim of the market's whims. Now I want you to do one more thing. I want you to go to the comments section and write one sentence about how you will apply the lessons of this video to your own life. How will you begin to think like a mathematician? How will you protect yourself from the tyranny of emotion? How will you embrace the power of process? Your journey starts today. The choice is yours.